And let me also, I want to share my screen. Let me know if you guys can see my screen. What, if you guys don't mind, tell me, what do you see?
Chart, bar graph.
Okay, it's
You're
not,
doing
it wasn't a,
slideshow.
what's that?
A slideshow. You're going to talk about the market, asset types.
Okay, great. It wasn't a trick question. The reason I was asking was because sometimes when I go split view, it shows like my desktop or something like that. So I just wanted to make sure it says private. You should all see a screen right now that just says private mortgage lending basics. So hopefully that's what you see. And if not, let me know, because then we have a problem. All right. So I'm not going to talk a whole lot about me, although I know this is being recorded and it's going on YouTube and the Twitter spheres and social media world. But that's me. Been in real estate 13, 14 years. When I tell my story, I got into real estate. I tell people I had a dream and a drive. I had no money. Basically, I started this thing on a credit card. I had actually just finished going through, in the year or two previous to me getting kind of educated about real estate. My wife and I went through a Dave Ramsey course at our church. And, we learned that about bad debt, which is credit card debt and student loan stuff that we had. And so we paid all that off and worked really hard and always kept good credit. And then I read Rich Dad Poor Dad and Robert Kiyosaki, amongst dozens and dozens of other books that I just couldn't stop reading, and began to build my financial knowledge, which I had none. I had zero. What they don't teach you this stuff in school, and didn't teach me much in college either. I studied criminal justice, went into law enforcement. So I had really zero financial education. I'm not proud of that. That's just how I started. And so I read a few books and we did the Dave Ramsey thing. And I was like, woo, we're debt free. And then I read Robert Kiyosaki. I'm like, woo, let me go leverage millions of dollars of debt in real estate. And so lo and behold, I use one of those credit card checks that you may not have seen in the mail. And I used only one of them for $7,000 to buy a rental property. And I leveraged that first deal and to do 10 more deals, utilizing hard money lenders and banks. And I began putting partnership deals together, and that was great. But I realized I was only keeping half the deal. And then I learned about private money. I've been raising private money and utilizing private lenders and my lending relationships since that time. And, we've done hundreds and hundreds of deals. And it's kind of been part of my mission is to, do as many successful and sustainable real estate deals as I can do. Because while I'm doing this, it's helping my lenders out at the same time. And I'm, most proud of the fact that I've never not performed on any of my loans ever after doing hundreds of deals. Even on deals I've taken losses on, my lenders have not. They've earned every penny that I've agreed to. It has not been easy, and at times, but it's been very rewarding. And so I started teaching people about private lending many, many years ago. And not just my lenders, but other people, speaking at places like Quest IRA, speaking online, speaking at events. And I'm just 100% a big raving fan of private money. I've encouraged, my parents, my in-laws, other family members have self-directed IRAs. They can't invest with me necessarily. So I've, taught them this too. And they've been doing the same thing for years, investing in other people's deals using this model. And so I just know it works if you do it the right way. So this is not really my, I was going to say like a humble brag. I'm not bragging about anything because I'm not perfect. I've made a lot of mistakes. And, but what tonight is all about, there's no sales pitch. I have nothing to sell, pitch, promote, anything like that. But I'm a big believer in private mortgage lending, and how great it works compared to stock markets and just the volatility of other options out there and insecurity with and uncertainty with other markets and other investments. And when done right, real estate really does provide, us with a very solid, stable, predictable, investment. And I love it. I'm passionate about it. And I saw so many people, including friends and family members, get wiped out by the stock market in 2008 and 2009 area. And when my business was really like taking off, and I'm like, I'm creating all this wealth with cash producing assets, and I'm seeing people lose their jobs and all their hard earned money in the stock market. So I like to teach and preach a little bit, I guess, about how great this is. So that's all this is about. I'm going to run through some slides, give you guys just a base, some basic information, base level of knowledge about private mortgage lending, and answer any questions I can. And so let's start here too. While saying I'm not an attorney, I'm not an accountant, I'm not a financial advisor or anything like that. I'm not offering anything, any security or anybody an opportunity to invest with me. My attorney told me to say all this years ago. One of the first things I did was meet with an SEC attorney. And I said, what can I not do when it comes to raising money? And he said, look, you can educate people till you're blue in the face. You can do that all day long. You can do it online. You can do it publicly. You can do it private. You can do it workshops, whatever. You educate. Just can't raise money, like ask for people to invest with you and all that stuff. So I'm not asking anybody to invest with me, but I am going to educate some blue in the face. And when I'm not doing much real estate, that's my family there. Yes, we have 5 kids. I always like to say there's probably a couple more hiding behind the couch somewhere, but I digress. My wife, and that's why I was also busy. I got home from a long day at work, went outside, played soccer with a couple of the kids, and then football, and got on the attorney call. And now here I am. So everybody good to go? Everybody locked and loaded? All right. So let's just start here. So successful investing is about managing risk, not avoiding it. So I see so many people that don't do what you guys are doing right now, which is just getting a little bit of education and getting some information, obtaining some data, and so you can make a decision. But I see so many people that they avoid risk rather than manage risk, because there's risk in everything. Is there risk in what I do as a real estate investor? Absolutely, 100%. There is risk. Like I see a lot of real estate investors come into the business and leave the business, and they're not leaving by choice, right? And so, there is risk involved, but there's also ways to manage your risk. And that's what I am. That's probably, if I boil down to everything that I do, and I'm a man of many hats, I'm a risk manager, right? I manage risk, the risk that we do in our single family deals, mobile home parks, all this kind of stuff that we do. I manage risk, right? So my, goal is to have a sustainable business. I've been doing it 14 years, and I probably have 20 or 30 more years to go till I quote unquote retire. Although I never hope to retire, so maybe it's longer. Maybe I'll be like a Buffett until like I'm 80, and that'll be my job still at that time, is to manage risk. So that's what your job too is, right? As an investor, as a private or passive investor, depending on which hat you're wearing or wanting to wear, is you want to manage risk. So for those of you who are watching this, who've never invested in real estate or looked into it too in depth, let's look at some advantages of investing in real estate. And this is really for people like me, like people who are wearing the real estate investor hat and doing deals. So why do guys and girls like me like real estate so much? Well, pretty much everything you see on the left, right? So it's a hard, tangible asset. It yields cash. We're able to leverage. Like I said, real estate was provided me the opportunity to come into this business and trade my time, energy, and effort, and just my resources, which was just hard work and determination. I could do that. I could leverage other people's money to go out and find these undervalued assets, these properties, manage rehabs, lease properties, manage property management, do all these things, these high time investment type of activities, but I could leverage other people's money to do that. And that was just something other investment opportunities really didn't give me the opportunity to do, at least not to my knowledge. And also there's also tax advantages, and there's equity buildup, right? There's equity buildup. Like we just put a property on the market today, as a matter of fact. It's a property I've had for like 10 years. And I had the same tenant and the entire time. The tenant moved out a couple of months ago. We put the home up for sale. And I mean, it'll be a 6-figure profit, right? With the same tenant over that same period of time. So she drastically reduced, the amount of principal that I owed on the property by paying me and me paying my lender. And then also at the same time, appreciation has occurred, right? All at the same time, I'm getting tax advantages. So makes sense. That's, the basic, real estate 101 on why, people like me do what we do. And so that you understand a little bit like what is the motivation and the mindset for real estate investors. That's what, is driving a lot of people there is and really it boils down to that middle one is leverage. And that's where you guys come in. Because we're able to leverage private lenders' money, and not just ideally. I mean, like I believe wholeheartedly, like this is the real win-win kind of proposition that we're making here with private lenders and borrowers, and then it goes deeper too. I guess I'll get into that in a little bit, but there's win-win-win-win-win. Like we've kind of boiled down with our mission statement in our company. Like we have a mission statement to impact 10,000 lives in the next 5 years. And we're like, that's a lot of lives, Brant. And I'm like, yeah, you're right. But we also, like, every deal that we do very conservatively impacts in a positive way at least 10 people's lives, right? So you've got the seller, you've got the lender, you've got multiple contractors, you have our title company loves this. You've got surveyors, we're paying government taxes, we're improving neighborhoods, we have a property manager. There's all these people that are affected, right? Probably 10 or 15 contractors alone, plus all these other people every time we do a deal. So it is making a big impact. And that's kind of the other underlying story of all this. So let's talk about what is private real estate lending 101 though. Whenever you are lending to real estate investor, what is this? So it's basically non-bank real estate lending, right? It's a lot like bank lending. It's just coming from an individual. So what do we use these loans for? To purchase property, sometimes to refinance, new construction, things like that, and just rehab costs. So obviously there's different underwriting standards than a bank or more conventional sources. And the bottom line is you guys are you're the underwriting department. You figure out what it is you want to ask for or not ask for. Rates are typically between 7 to 12%. And like I mentioned previously, that when you do it the right way, these investments are asset-backed investments that will provide you security. And when done right, also, they offer solid, predictable returns. Hey, I'm not a stock guy. I have some stock, and the stock, I have like one stock. Okay. I mean, like I'm invested in one company in stock, and it's going through the roof, and it's awesome. Like it's great because it's like doing incredible, but I'm not a stock guy. I have no other stock, and I'm assuming the stock, even though it's doing phenomenal, at some point in time is going to go down. And the fact of the matter is, I never know if it's going to go up, down, or sideways. But real estate, is solid in terms of, if I agree to pay 7 to 8% to my lender, guess what they can expect in their mailbox or ACH every single month? 7 to 8%, right? Like clockwork. And so that's when it's, once again, I'll say when done right. Okay. When everything, I should just put at the bottom of this presentation, when done right. Because if you do it the wrong way, it doesn't work out that way. And I'm also a lender myself. So I do a lot of private lending now as well. So I wear the hat that you guys are in also. So I can relate. And I've only lost money, by the way, on one lending deal where I was the lender, right? I lost my money, and it was the very first one I did. Why is that? Because I didn't do it the right way. I did it the wrong way. So that's what I want to help you guys avoid. So the bottom line is, whenever you invest in real estate as a private lender, you really get to your money works for you instead of you working for your money, right? And so you're basically the bank. And once you do your due diligence on the front end, that money can just begin to grow. And even some people think, hey, Brant, I want to do what you do. And I've got some money to invest, and I want to invest it, and I want to fix and flip some houses and do that kind of stuff. Well, I will tell you that what I do, and this is something for everyone to consider too, if you see this slide over here, where it says less liability than owning the real estate yourself in your IRA. I've got, cash and IRA that an IRA and cash that I don't use typically 9 times out of 10 on my own investments. I loan out my IRA and I do my own loans that I loan my cash out. It makes more sense for me to leverage other people's money and put their money to work in my deals, and for me to loan my money. Okay. I get a higher rate of return by loaning my money out, and I'm able to borrow money at a lower rate of return. At a lower rate than I can lend my money out. So for me, that makes sense. It's something for you to think about too. But there are advantages and disadvantages, but that is what I do and been doing for years. And yeah, when you do it the right way, it can be a very low maintenance asset. And there's opportunities to combine funds with friends and family members and stuff like that. So let's talk about, why would a borrower use a private lender? Number one reason, that real estate investor needs a quick close. So this isn't always the case, but it's typical. Okay. So whenever we make offers to motivated sellers, one of the number one reasons, the value adds that we have as a real estate investor to a borrower, is that we can close quick. And that's a big thing for a lot of our sellers. That's why they're called motivated sellers. Like, they have some type of motivation. Sometimes it's financial, sometimes it's relationship wise, it's some other issue that maybe they're moving for a job, whatever it may be. Doesn't really matter. It matters that they need a quick close, and we're the ones that they called, and we promised them we could do that. The only way we can do that is with a private lender, or a hard money lender. We don't like hard money lenders. I'll talk about that a little bit. As a rule, we do like them. Actually, some of my best friends are hard money lenders, and I've used them a ton over the years. But I kind of have a conversation of, when a real estate investor is using a hard money lender, it's like riding a bike with training wheels. And at some point in time, you want to take those training wheels off and kind of, ride like a big kid. And with private lenders, is typically a better relationship, lower rates, little more favorable terms than a hard money lender. The rates are really high, very painful. And honestly, in a market like this, it's harder to stay profitable using borrowing those rates and terms. So that's why we use private lenders. Number one, first and foremost, we need a quick close. We only need the funds for a short period of time. So that's not something that a conventional bank is going to be interested in. The real estate investor may have weak credit or income documentation. And that's to say income documentation. They may have weak income too. You have to look at that, but they just may not be able to document it, because a lot of real estate investors are full-time real estate investors and have a lot of W-2 income. Some of them may have weak credit. You need to look at that. I'll tell you that, I really don't remember a private lender ever asking for my credit report. I think maybe one time. And it's always kind of upset me a little bit, because I've always had good credit, like always, since high school, since I got a first credit card in college, I guess it was. I've never had anything bad. And I didn't do that great in school, to be quite honest with you. So I never got to like bring home report cards and brag about that a whole lot. And so I've kind of like want people to ask me for my credit score so I can be like, look, mom, I did good, so I can brag about that. But people don't ask for it. So, but it is absolutely your prerogative as the lender. You're the underwriter. You can ask for whatever you want to feel good about, making sure it's a good credit risk for you. But you need to keep that in mind that your borrower may have weak credit and income. That doesn't mean that you don't want to invest in their deal. It may mean that, it just may not. You have to take everything into consideration. We'll talk about how to analyze a deal and how to analyze a borrower in a little bit. But back to why would a borrower use a private lender? Construction and bank loans, they don't make sense. They're not quick. Banks are not quick in anything that they do. They may require a large down payment. They may require draws. There's all these other issues. There are tons of paperwork too. And, they're more private money loans are typically more cost effective and efficient than hard money loans. And that's really what private lending has done is if you've got bank lending at a certain point, you've got, say 5, 6, 7% interest. And it's very friendly on the interest rate side of things. A lot of cash out of pocket too. And you've got hard money lending that's up here, extremely high interest rates, a lot of points, a lot of fees, still a lot of paperwork. Private lenders are typically like, it's right in the middle, right? So it's kind of filled the gap between the banks and the hard money lenders. Let me know if everything makes sense to everybody, what we're going over so far. I'm gonna make sure I'm not going too fast, but that's where we're at. Any comments or whatever you want to post would be great, and I'll take a quick peek. But all right, so let's keep moving on. So all right, so where does it all start? So here's where you guys need to start. Start by defining your ideal investment. So what type of investment are you looking for? Single family, commercial, multifamily, other types. I need to update my slides. So we started buying mobile home parks, even bought an RV park in the last year and a half, and I love them, and my lenders are lending on them. So it just depends, for you, what would you enjoy investing in, right? And what if you had to take something back, what would that be? Hopefully that never happens, but just kind of ask yourself like, hey, what are you comfortable investing in? And invest in that. Do you want to invest short-term or long-term, right? These can be typically they're at least a year long. I never like to set up my loans less than a year. And the reason for that is it doesn't mean that we use them for the whole year. We're typically in and out of loans in 4 to 6 months on our fix and flip deals. However, I went through 2009 and refinances were incredibly slow. They were non-existent for a while. And so I have always found that in the event of a market shift, in the event of a flood occurring or something like that, I want to prepare myself for worst case scenarios. So we also have minimum of a year, but I've had private lender loans go as long as 7 to 10 years. So some are much longer. And the rate of return, are you looking for a high rate of return? Well, then you're probably looking at a higher risk or at least a less experienced investor, which may mean more effort on your part. If you're happier and satisfied with the lower rate of return, well, typically that's going to mean it's going to be a little less risk and a little less effort on your part and probably a more experienced investor. And so one formula that I found works really well is an inexperienced private lender should most likely always begin with a very experienced borrower, a real estate investor. Like myself, I've done hundreds of deals, but if you were just getting started and you were lending to someone who else was just getting started, this is a bad formula. No experience lending or little no experience lending, little no experience borrowing, bad formula. But let's say you've got 10, 15, 20 deals under your belt as a lender, then you lending to an inexperienced borrower may make sense. You can typically earn a higher rate of return. Why is that? Well, I like to say that you can tell the experience of the borrower by what they pay for their money. You can tell the experience of the borrower, or you can tell the experience of the investor by what they pay for their money. So like I said, if you're working with a newer investor, that may be okay if you're experienced, if you know how to qualify the deal and you're comfortable with everything. That's who I loan to. So for the most part, are newbies, people just getting in the business, charge a much higher rate of return or a higher interest. But I know how to analyze them. I know how to analyze their deal. I'm not really concerned with the risk, although there are some. That's okay. So you just have to kind of look at your situation. So how do you find and qualify investors? Well, they're all over the place. It has got a little bit trickier with COVID, where there used to be networking and educational events going on all the time. Now they're just on Zoom, so it is a little bit harder to qualify people not meeting in person. But you can still do that online, social media. There are some networking events going on again, social media. Asking other people, industry professionals, who am I talking about? People who are in the investing space, maybe contractors, maybe insurance agents, maybe surveyors, maybe title company. Just start talking to people. Whenever you have some investors that you may be interested in looking at, I would say verify sources, ask for references. Have they worked with other private lenders before? Other people in the business? Interview them, of course, talk to them, meet with them, do a little social media scroll. Okay. So one of the things that we do whenever we are going through a hiring process for someone, one of the first things that we do is go on social media, and you would be just flabbergasted is the word that comes to mind at what some people post, knowing that they're going to be applying for a job and all this kind of stuff. It's crazy. So you can learn a lot by people these days on social media. So go on the internet and dig around, pull some data. Don't be afraid to ask for a personal financial statement, some of their financials, credit report, number of deals they've done, number of years in business, stuff like that. Okay, so how do you analyze a deal? So let me pull this out and have you all take a look at this for a second while I grab a sip of my little shake here. All right, sorry about that. I'm very thirsty. All right, so how do you analyze a deal? So appraisal, a CMA, comparative market analysis, or a BPO, absolutely you can. I will tell you that when it comes to when we do a deal and our lenders loan us money, we pay for all the closing costs, all the fees, all that type of stuff. We do not pay for an appraisal, a CMA, a BPO. We provide a CMA upon request. Now, a lot of our lenders like to do their own diligence, run their own CMA. They may have a real estate license, or they have a friend who's a realtor, do their own due diligence. But if you want an appraisal or BPO, that's something you would need to pay for. And I have had a couple of my lenders who were new, and I think they trusted me, but they just wanted to feel safe. So they went ahead and ordered appraisal, and I was fine with that. I think they ordered a desktop appraisal a little bit cheaper. So it's like, I understand, like, do whatever you need to do to feel comfortable. Because if you can't sleep good at night, look, guys, it's just not a good investment. That's a saying I've had for a long time. It's like, it's not a great deal. I don't care what you're making if you can't sleep good at night. So you can order an appraisal, you can get a BPO, all that kind of stuff. But the numbers that we use, you really want to look at your loan to value ratio. So I use this little example here. If we were buying a home that was going to be worth $100,000, then we, as an investor, if you look at the math, like, we're probably going to buy it for $50,000, put 25,000 or so in repairs, and so this is a little bit thrown off. $70,000 is 70% ARV. Okay, so after everything kind of gets said and done, let's say, for example, you loaned $75,000 to us on this particular deal. that would mean that you have 25%, right? There's 25% equity in this deal. As a fix and flip deal, I would tell you this is kind of the minimum amount. Okay. You would not want to accept any less equity than this in the deal. Because this, unless hopefully it's going to be a super quick rehab, the investor's going to, make, $12 to $15,000 on it, hopefully maybe 10. That's kind of a minimum deal. It's a very slim deal. I'm just being honest with you guys. We're really looking at deals that have about 30% equity in them, is what our target is. Now, in a seller's market that we're in with a lot of competition, we do go into this range as well. But the bottom line, what I want to communicate to you guys is that 25% equity position. You have to realize that 25 equity position is your oxygen. I like to say, in case the deal goes bad, in case the whatever, your borrower, God forbid, is, out of business or not performing or whatever. I hate, I hate when I hear it, but I've heard stories, and guys are not always good, honest, ethical people. So you always want to protect yourself with that equity in the event you have to take a deal back. And you can ask for more equity. You can say, hey, on this particular deal, I'm only comfortable loaning $70,000. Well, if that's the case, then that investor needs to bring $5,000, or they need to find another lender, what have you. You need to make sure that you feel good in your equity position and that you feel like you're winning, they feel like they're winning. And this is just a baseline. I encourage all you guys to go do your own due diligence, do your own research, and find more equity. And this, and I didn't really talk about at the beginning, but this is a shameless plug because it's coming to mind. A lot of this is based off my book, which you can't really see here, but the Private Lender Playbook. I'm not getting a good camera view. But take some time, read that book. If you email me, I'll send you a free copy of it, like a digital copy. You can read from your phone or your iPad, because it is important that you do get educated on this if you're going to move forward. So rating the risk factors. So what are some of the risk factors, right? We just mentioned that equity, your loan to value. What is a minimum? 25%. Look at the experience of the borrower. We talked about what is the background of the borrower. They have a strong business background. Even if they're a new borrower, maybe they've got a strong business background, construction background, management background, things that, favor them, in terms of you wanting to invest with them. What are their financials? Do they have skin in the game? Is it a heavy rehab or a light rehab, right? A big, heavy, intense capital, high capital, $100,000 rehab or whatever. That's a different risk factor than a paint and carpet rehab. Okay. Much different risk factor. What is your draw schedule? What are they asking for? What are you comfortable with? Statistically, flips are a little bit riskier than rentals, right? If it's a rental, paint and carpet, get a renter in there. That's a safer asset than a vacant property that could take 3 to 6 months to rehab. Markets can shift and change. There's acts of God, there's hurricanes, things like that happen. So statistically, rentals are a little bit safer than a flip. What's the condition of the market and the sub-market, right? Our overall market, like what's the real estate market like in general, and what's going on in that subdivision, right? Maybe even that section of that subdivision. So you want to look at the macro and the micro with the market, and then just go with your gut. Just go with your gut. I've talked to some lenders, some have been brand new, and they're looking at a deal, and I've had lenders where they're almost like apologetic to me, like, Brand, I really want to do this, but I can tell they're nervous, and almost have to just let them know, say, hey, it's okay. Like, you need to be excited about this. You need to be happy about this. You want to sleep good at night, and it may not be the right time, and that's okay. And what I've really found, like when it comes to private lending or really anything, is the first time that we're doing anything, there's fear, right? And this just applies to all areas of life. And But the more that we educate ourselves about certain things and the more that we experience certain things, as experience and fear, experience and education increase, fear subsides. Okay, as education and experience increase, fear subsides. It's the same thing with lending. The more you do it, the less fear that you have, and you get the fear turns into familiarity, and you're able to navigate through it, find out what are your concerns, how to satisfy them, and say yes or no based on what you find. We're doing this mobile home park deal in Illinois, and I was just on the phone with a broker from Illinois right after I got off my attorney, and I had a lot of fear, right, with this deal, an out-of-state deal, a blue state, what's going on over there with rent control, this kind of stuff. And I factored all that in all along, like we're getting it just incredibly cheap, I'll tell you that. And I told the broker we're getting it for. He's like, holy cow, yeah. He's like, I think you're doing very good. He's like, you can move that quick if you want to just flip it to some of my investors will buy it right now. I was like, we may do that, I don't know. But so my point is, I had a lot of fear doing this deal in a market I'm not familiar with. So it caused me to stay awake at night, some nights, and figuring out, okay, what is my fear? What, and going back to data. Can I find data, information, resources, other people that help me overcome this fear? If so, great, I'll move forward. If not, then I won't, I'll back out. So it should be the same thing for you, is figure out where your fear is coming from. Is it, is it real? Is it something that you need to dig deeper on? Is it something that you can overcome with information, feel good about? Or is it something you're just not going to feel good about it? So that's where you just kind of have to go through that process. So how do you secure a deal? Or really, I should say, how does your real estate investor secure the deal for you? But this is really your number one job, is to make sure that, these things are done to your standards before you send that wire, or before you approve the wire being released by the title company. Okay, so how do you secure your investment? And guys, this is so critical. If any of you are not paying attention to this, whether you're live or watching a recording, I don't have your attention. I hope I have it now. Okay, I hope I have it now, because you could have found a great borrower and have plenty of equity in the deal. But if you fail to, doing these items, you could put your investment at jeopardy. So this is really, really, really important, guys. And this is the thing that makes investing in real estate so great, is not just the, the rate of return, anything like that. It's really the security, right? You can earn, like, historically, depending on which reports you read and all that kind of stuff, like stock market over the long term, 20, 30 years does great. It's like 8% or whatever it is. I don't know. It's like in that range, right? And there's nothing wrong with 8%. The problem is this kind of stuff, the ups and downs. And that's what we want to avoid. Well, if you don't do this part right, real estate could have a big down. Okay. So what do you need to do to secure the deal? Make sure a real estate attorney prepares the loan documents. I have a real estate attorney that I've been working with for years, but he is acting on behalf of my lenders. I'm paying for it, but he's writing the docs up in your favor, not mine. So what do you need? A note, deed of trust. I'm in Texas. Some states are a mortgage state or a deed of trust state, but you need to make sure you have the proper financial instrument to secure it. In Texas, it's a note, deed of trust, and then the note outlays the payment arrangement. I provide a personal guarantee on all my deals. Some real estate investors don't do that. I do it. I give a personal guarantee. We always close at a title company. We always provide a survey. We always provide a title commitment and insurance, title insurance. We provide property insurance, clearly to define repair escrow terms if there's a repair escrow involved. And then last, I put just working knowledge, understanding the terms and the structure of the deal. So if you don't understand something about the process or the paperwork, ask your borrower, better yet, just call his attorney or call the title company. All right. So if you do those things, you can successfully secure your deal. All right, so this is the process. I'm going to speed up a little bit, but it's pretty simple. I mean, the borrower finds a deal, the borrower and the lender discuss discuss the deal, the rates, the terms, all that kind of stuff. And then I like to say that private lending is really a handshake agreement backed up by the proper paperwork. So if you see there on the top right, the borrower and lender agree on terms. They get that information to the real estate attorney for doc prep. At the same time, the title company is working on title commitment, getting insurance, getting survey, all that kind of stuff. Go to closing. Money's finally exchanged. By the way, you do not send wires directly to your borrowers. Wires go to the title company. All those checklist items that you require are checked off. The title company should be instructed by you not to wire until those things are satisfied, until you release the wire. After that point in time, the wire is released, property is closed, whatever portion of rehab money that you've released to the borrower gets sent to begin project renovations. And at that point in time, you're going to start receiving payments via whatever note structure that you have. And then those payments will continue if all goes well until that borrower either sells or refinances their property. And most likely, I'm going to cover that really fast, but you're probably going to want to keep doing it. I kind of joke that I've only had one private lender who didn't continue to invest in us. Only one. Like, all of our lenders come back, and I'm very fortunate and grateful for that. One didn't reinvest with us. Actually, I lie. It's been two now at this point, that at the time of this recording, because was one recently, but he's fairly new, so hopefully he'll come back. But one guy he was kind of not easy to deal with, is the way I'll put it. He's kind of a jerk, to be quite honest. And he did a loan with us, and less than 2 months in, it was a rental property loan. It's like a 1-year loan. We were going to buy it. We bought it, rehab it, stabilize it, rent it, and then refinance. And at the month 2, he was calling for his money back, and he wasn't polite about it. And we got him his money back. And then he did come back to us later and told us the deal fell through, and he wanted to reinvest with us. And we respectfully told him no, because he was rude during that time. We didn't like that. We like nice people. So it's funner for business. So anyways, all right. So short-term versus long-term. I like to talk about, when I have more time, about, the tortoise and the hare. And you have to figure out which one you are, because there's not a right or wrong answer, because, it's not a trick question like saying, everyone knows the tortoise wins the race. Well, there's a strong argument for slow and steady, slow and steady, slow and steady. If you do not want to be very active in in your private lending, then I would encourage you to find some trustworthy investors that you can put your money to work for the long term, 2 to 5 years, something like that, at a very, fair 7 to 8% interest rate. That money, steadily working over time, is going to outperform, the 10 to 12% money if it's sitting for long periods of time taking a nap. Okay. And that's what I've seen happen as people get into this private lending thing, and they're like, hey, I heard I can make 12%. And I'm like, you can. And so then they'll, take sometimes 3 to 6 months. I sadly have some friends, and every time I talk to them, they're like, and actually it's really a family member, because they can't invest with me, and their money sits way longer than it ever should, because they're looking for 12%. I'm like, just put it to work. And they're not. It's sitting on the sidelines, being lazy, not earning anything. And so if you want to earn high rates of return and charge points and all that kind of stuff, you can, but you have to understand there's work involved to go out and find borrowers and vet their deals, right? And look at the macro and micro markets, doing some CMAs, doing all that stuff, versus just like parking it with someone you trust. So it's up to you guys. But there is a definitely a debate to be had on the short term versus the long term. But that's all I'm saying is that if you are very aggressive and you're willing to do some work and roll up your sleeves and keep your money at work by constantly getting it reinvested, then you can do really well here at higher interest rates. But you know, if you're not committed to that, then you may want to go with the short-term route. All right, so I'm going to just blow through a couple of case studies real quick. If you guys have any questions, feel free to post them in here. It's just really just kind of generic flip deal. Although this is really actually a flip deal that we completed this year. It was a nice one. It was around a $43,000 net profit for us, I believe. I just was reviewing financials the other day for my bookkeeper. And so, yeah, so this deal we bought for $106,000, spent about, let's just say 50,000 or so in repairs. And we borrowed 160. Typically, if there's equity in the deal, we borrow 100%. And I say 100%, like to borrow for our closing costs and all that type of stuff. If there's equity in the deal, we will. If there's not, then we won't. This one, there definitely was. This was in the Missouri City area of Texas, and it was just like a cookie cutter deal. But you can see this, actually I think it was a 4-bedroom, 2-bath home, 2-car garage. Just a cookie cutter subdivision. It was just a slam dunk home run deal. If I could do 10 of these things a month, I would absolutely do it. So that was a good, win-win for everybody. This was, let's see, this is a rental property. It's a rental property. I think this was in the 7705. Oh no, this was in LaPorte, I believe. So the loan amount on this one was $111,000. We borrowed at 8% interest for 36 months. We had a tenant. Actually, we had 2 tenants. We had one unfortunate tenant, so we had to get them out and get another one in. But we owned it for like 2.5 years or so. The last tenant was unexpected, and so we just put it on the market, and we actually ended up selling this property. But we had their money at work for 2.5, close to 3 years, and I think we had to extend their loan out a little bit, if I recall, to wait until the house actually sold. But still, like a very cookie cutter, safe deal. With me, you won't find a lot of these real high end, $500,000, $800,000 exotic flips like you see on TV. That's just not what we do. We're very cookie cutter, vanilla, 3-bedroom, 2-bath, 2-car garage, medium price housing and below is what you hear me say a lot. That's where a lot of our investments are done. We invest in blue collar neighborhoods because we like to have multiple exit strategies. We can flip these homes, flip, rent, owner finance, what have you. So, in terms of case studies, this I wouldn't really say it's a case study, but I threw these pictures on at the very end. This is what a couple of things we've done in the last year and a half. This is a mobile home park, but it's like an RV. We have RVs, mobile homes, cabins, and actually there's a 3-bedroom, 2-bath right here. You can see a single family home that we own. We put that fencing up around all that. Our park manager lives in this home. We still charge rent. We charge $1,400 a month in rent, but she makes $600 or so a month to manage the park part-time, just very little things she does there. She's kind of our eyes and ears. And then she also has some like little bonus incentives there. But anyways, my point of sharing this was a pretty distressed property that we bought about a year and a half ago with private money. And, all in all, we've invested about $600,000 of private lender capital into this park, and its frontage of Interstate 20 in the Longview area. And as of last month, beginning in November, we received a $1.2 million BPO, broker price opinion, and we've actually just gone to market to sell this property. So pretty good numbers. If you were a private lender, say, hey, I've got 600,000 invested in a property worth $1.2 million. And it's based on that valuation, by the way, based on its income. So these are evaluated on a cap rate, not on like a LTV or anything like an ARV or CMA, like a single family home. So that's kind of just something that we've added into our portfolio in the last couple of years. And any of those of you who follow me know I've spent a lot of time and just a lot of time and money researching mobile home parks and talking to people, going to boot camps and studying and reading and listening to podcasts. And we've done a few deals and they're really excited about them. And we've been able to finance those with our private lenders' money. We have a commercial deal, that we've done with private money, and actually bought an entire subdivision. It's a 51 lot. They're 51 half-acre lots that we're doing. This down in Brazoria, Texas, and funded with private lender capital. And this has been just it's still in the onset. It's like we just bought it this summer. So we're still working on this one. We're turning this one around. There's a lot of work. We're putting out houses and things like that. But once again, all from private lender capital. So this is like, kind of wrapping it up, but very important. So when I say like, this is backyard investing that feels good. So, you got to think like Wall Street versus Main Street kind of thing. What your money's going to is not just that deal, not just that real estate investor, but we're renovating neighborhoods. We're renovating, neighborhood homes, but also entire communities. Like we're turning around this entire community down there in Brazoria. We're hiring local contractors, service companies, buying materials from local hardware, lumber stores, landscaping places, granite stores, all that kind of stuff, providing housing for hardworking families. And at the same time, you can be earning passive, above market rates of return with, no, I'm not saying there's no risk. I'm just saying there's substantially less risk when you do it the right way. You've got that security that you don't get with Wall Street. You don't get a lot of other places. And it's just an all around feel good investment opportunity. And it's, Wall Street versus Main Street. Well, Main Street wins. And that's why I mentioned that, our goal is to impact 10,000 lives by doing, because we know that every deal that we do, there's at least 10 lives that are impacted, financially and just in some positive way. And so that boils down to us doing 500 deals in the next 5 years. And that wouldn't be possible without our private lenders. And this is a short thing. And actually, I won't go too much into it, but if you look at, if you ever read my book, Private Lender Playbook, there was a very flattering forward written by one of my private lenders. And I just asked them to give me a review, like a testimonial kind of thing, and wrote a couple pages of text that was not just very well written, but it was just very humbling. But he really encapsulated everything about the private lending experience from a lender's point of view. So encourage you guys to read that. But he really just summarized it very well with, Wall Street, CDs, all these other investment opportunities out there. And he was basically, no, we're not doing that stuff anymore because we found a better way, and it's private mortgage lending. So I'd encourage all you guys to take a look at that and see if this is a better way for you. Maybe it is, maybe it's not. I know typically the lenders that I work with love it, but that's what all this was about, was really just showing you kind of the playbook of private mortgage lending and just offering you guys some information. And so that's my contact information if you want to reach out. Appreciate all you guys for joining me. And I have a couple minutes here if you want to ask any questions. Be happy to answer those.
Hi, Brent. Can you hear me?
Yes, I can hear you.
Yeah, I actually, we showed a house near Missouri City, Texas. Like, it's very close to home. So if there are deals around that area, I would like to partner. Is that a possibility?
You want to partner
Yeah,
with a,
I can finance it.
you've already bought it?
No, no, I'm just telling you if you have any lead. I didn't buy anything.
Oh, I'm sorry. The it's kind of muffled. It's hard to hear you.
Oh, okay.
So
I,
are you under contract on the property?
no, no, I'm asking you if there are things around like Houston area. I would love to partner.
Oh, okay. You want to you want to bring a deal to us, or you want to partner as a
If
lender?
no, not bring a deal. I like I'm not very good in finding a deal. So
Mhm.
if you have your students or somebody, I don't mind funding and also working
Yeah.
together.
Well, one thing that we have done, it's
Hmm.
not partnering per se,
Hmm.
but we've done what we've called equity participation mortgages before
Okay.
with lenders who say, "Hey, I want a piece of the pie, a little equity."
Hmm.
And so we've done equity participation deals,
Hmm.
and what those look like, they're typically we do them on our non-standard deals. Okay. And
Okay.
maybe it's a little bit of higher end property. We did some of these after Harvey. I'm in talks with one lender right now on doing it on one of our smaller mobile home parks. And
Hmm.
what that looks like is it is a mortgage, and we, rather than doing it a partnership, I
Hmm.
don't like to do a partnership because that may be a whole other LLC. Now we're waiting on tax returns together. All this there's a lot of complexities in a partnership that I don't
Okay.
like.
Okay.
A joint venture, like doing a joint venture, there's
Hmm.
not a lot of security there for
Okay.
you. Don't like to do that either. We do JVs or joint ventures with like bird dog people, like guys that bring us deals, but they don't have any money in the deal. We'll do
Okay.
a joint venture. I'm open to having a conversation about equity participation mortgages with my lenders, lots if it's win-win. But what
Yeah.
those will look like is, let's say, for example, we've got a smaller mobile home park deal. That one's fresh on my mind. We've got a
Okay.
smaller mobile home park deal that we're getting for, it's 24 lots. We're getting for like $100,000, which is really dirt cheap.
Okay.
But it needs, a couple $100,000 in work.
So,
How that looks like is the mortgage is a very low interest rate.
hmm.
Say we'll pay like 3% interest on your investment.
Hmm.
Okay. And so that's paid out, but you
Okay.
also get an equity piece when we sell.
Oh, okay.
So it's written in the mortgage. Why do we pay a low interest rate? Number one, we pay you interest because if there's no interest payments being made,
Uh-huh.
then it's not truly a mortgage. And say, for example, if we weren't making any payments to you,
Uh-huh.
and this is something that it's like why it's so important having a good team, a good real estate attorney. Like
Uh-huh.
if we weren't making, let's say it was just accrued interest and we weren't making any payments to you as a borrower. Well,
Uh-huh.
what if something happened to me? Like, what if I died? What if I get hit by a car and I was like comatose? Well, because I wasn't making any payments to you because the loan didn't require it, have I really defaulted? You know,
Uh-huh.
does that make sense? Like you can't even like start to get your.
Yeah, because you never paid anything, so there is
Yes.
no default.
Yeah. So we like to keep it as a mortgage. A
Uh-huh.
mortgage meaning we're paying you payments, right? So you, like, God forbid I didn't perform, you had the ability to take the property back. But
Okay.
then we create an equity piece, and
Uh-huh.
it's typically structured like HUD to HUD,
Uh-huh.
saying, hey, what if we have, whatever the profit is, you get this percentage, say 30% profit or 40% profit or whatever. And it's usually pretty sizable. So that's something we would be open to. But if you're asking me, hey, I've got some money, I want to partner with you on one of your deals, it just has to make sense, because if it's just a regular deal, that really doesn't make sense for us. But if it's kind of a non-standard deal, we may be open to that.
Oh, okay. Okay, that sounds good.
Yeah. But if any of you guys want to get on my list, just send me an email. My email's right there, and I'll make sure.
I will get your email.
Okay. Yeah, if y'all email me, if you're not on my list for some reason, which you probably are if you got on this, we do a good job at emailing out potential deals. And like I said, this is just a general information thing. There's a lot of other really good, investors in our market, in every major market as well.
Brant, can you hear me okay, Brant?
Who am I hearing? Is that Blake?
This is Blake. Yes. So you said you'll send out deals. How do you go and pick who you want to be the passive investors with you in those deals? Because maybe sometimes I would imagine there's a plethora of private money out on the marketplace, and sometimes you can have your picks, who you want in the deal, who you wouldn't want in the deal. How does that vetting process go?
Yeah. Great question. So, yeah, so we don't blast every deal. Sometimes I have a couple of lenders that I've promised I was going to get their money work, and I've earmarked, hey, and the next one's yours, next one yours. When we blast them out, here's the thing, Blake, is why I always tell my lenders, and when I was doing I used to do like a monthly lunch and learn with Quest, and I would say, all right, so here's the deal. You guys, your goal as a lender is to loan your money at the, highest rate of return and the most favorable, terms you can get, right? My goal is completely opposite of yours. My goal is to raise money at the lowest rate of interest with the best terms for me. So what it really comes down to is where can we meet in the, and both be happy. So the way I do it, Blake, and I started doing this years ago, was I used to just put out, hey, well, we're looking for 10%. We're looking at 8%. I stopped doing that. So we have like a cookie cutter email template that we can use. that we use. And we just say, hey, reply back with, the rate and terms that you're seeking. So we're looking for the best money where people are happy with. If you're looking for, hey, I'm looking for 12%, I'll tell you, we don't borrow at that. We're usually at 7 to 8%. Maybe we'll pay a point, maybe we won't. So you just reply back to one of those emails and tell me what you're looking for, and we'll let you know, if we're close or whatever. I get people to throw out 5% sometimes, and so I tell a lot of my lenders are good friends. I'm like, look, I've got a wife and 5 kids. I've got overhead. I've got employees. It's my job to raise money as low as I can. And I get it. It's not, I just can't do it with everybody, because some people want to loan at 10, 12, 14%. And I'm like, that's what I do. I would go do that if I were you, but it's just hard for me because we have a lot of people happy with 8%, which is kind of the norm.
Yeah. How close do you allow your investors to work with you on deals? And I guess I'll just kind of be a little bit open here to say, someone like myself to say, hey, Brant, this is something we want to get into or look at. First, I would like to be on the outside as a passive investor to look at how this is structured, how it works. And then I want to branch out on my own to go and do this as well. How close do you allow those guys to come in and say, hey, if this is something that you're looking into, come along under here. We'll show you a little bit of this.
Oh, yeah. So, I mean, our lenders are our partners, our lenders are our partners. So if you have any time you say, hey, I want to go take a look at the property, I want to go poke my head in, I want to check in, all that kind of stuff. Absolutely. Absolutely you can.
As long as they don't drive you too crazy, right?
Yeah, I mean, there's a little of that. There's a little of that, but I mean, I've got a full-time construction manager who's like the nicest guy in the world. So you want to meet with him and stuff like that, or whatever, you want to schedule a time to come to the office. Absolutely. But I'm not the guy driving around and looking at houses a lot anymore. I still do a little bit, but just not a whole lot. But yeah, you ask as many questions as you want. It's your money. Like I said, our lenders are our partners. So
Perfect.